So in this video, I want to run through the most important tax changes that are going to be coming into effect in 2025. Because the truth is, most of the measures that were actually announced in the budget last autumn haven't actually come into effect yet. We're going to be going through what they are, how they can affect you, and what you can do about them. I've spent 15 years working in finance. This is Modern Money Talk, where we talk all things personal finance and economics related. So I think we'll kick off with stamp duty, where there are quite a few changes going on. You pay stamp duty when you buy a freehold property, buy a new or existing leasehold, or buy a property through a shared ownership scheme. Now, at the moment, there's stamp duty relief for first-time buyers, and that's set to expire on the 31st of March. So what this means is that from the 1st of April, the stamp duty threshold for first-time buyers will drop from £425,000 down to where it used to be at £300,000. And it's also worth mentioning that 425 grand is where the nil rate used to be. It was increased during the much ill-fated mini-budget era, which we'd all rather forget. But it's not just first-time buyers that we're going to see stamp duty rates increase. From the same date, home movers, who are basically non-first-time buyers, will pay stamp duty on purchases over £125,000 rather than the current £250,000. So just to give you an example, based on the new threshold, a home mover completing on a property worth £500,000 will pay £15,000 in stamp duty rather than £12,500, which they'd pay at the moment. And the third and final change has actually already gone into effect. During the autumn budget, it was bad news for anyone who was looking for a buy-to-let or second home, as it was announced that the stamp duty for buy-to-let and second home properties would be increased by 2 percentage points. Next up is capital gains. So capital gains is charged on the profits that you make from selling an asset. These are things like investments, valuable possessions, property. Now, as with stamp duty, there are multiple changes going on here under the broad banner of capital gains tax, so we should really go through all of them. For starters, the rates are changing. So at the moment, the rate of capital gains tax that you pay kind of really depends on two things: your income tax band and whatever it is that you're selling. In the autumn budget, Rachel Reeves announced that capital gains tax rates on assets would increase from 10% to 18% for basic rate taxpayers and from 20 to 24% for higher rate taxpayers. Now, this is a change that took place pretty much straight away and brings capital gains tax rates on assets in line with the rates that you would pay on selling a second property. But also remember, you'll only pay capital gains tax on any gain that you make rather than the actual sale price. And it's also worth noting that gains can be offset against losses made when you're selling other assets. So the capital gains tax rates are actually going up. But as we mentioned, there's also another change that's happening. At the moment, you can make a gain of £6,000 in any given tax year, and that would not attract any capital gains tax. But this threshold is going to be lowered again to £3,000, and it is absolutely mad to think that this is an allowance that used to be all the way up at £12,000, but has been cut time and time and time again. Next up is inheritance tax. Sorry to get all morbid on you, but got to do it, so let's get into it. When you die, if your estate is worth more than £325,000, your beneficiaries will be liable to pay inheritance tax of 40% on everything above that threshold. And just remember that it's a marginal tax, so just because your estate goes over £325,000, it's only the money above that threshold, not the entire estate. But if you leave your estate to a direct descendant, usually a child or grandchild, then the threshold increases to £500,000 if the estate includes a residence that's passed directly. But also if you're married, you get additional tax relief. So if you're married or in a civil partnership, you also get spousal exemptions, which basically means that if you're married or in a civil partnership, you can pass up to £1 million of assets tax-free. The current inheritance tax thresholds were due to be frozen until 2028, but this has been extended until 2030. But the truth is, as time goes on, the impact of inflation means that more and more estates are likely to get dragged over the inheritance tax thresholds. At the moment, only around 4% of estates are liable for inheritance tax, but this is estimated to increase to 7% in the not too distant future. But the main change that's going to start coming into effect is how pension funds will be treated. It used to be the case that unused pension funds were basically excluded from the value of your estate, but all that is changing. From April 2027, your pension will now form part of your estate and therefore make it liable for inheritance tax. Now, whilst this change hasn't arrived just yet, you may want to consider making plans about how you can pass on your assets in a more tax-efficient way. And due to the 7-year rule, when it comes to making gifts, starting that process sooner rather than later will make your life much easier to do and will make tax planning much easier. We did a whole video on inheritance tax. Link for that will be in the description and at the end of the video. It's a very detailed video and I would really recommend that you watch it, because the thing about inheritance tax is that it is loophole ridden and there's a lot you can do to manage your inheritance tax bill. but is much easier to do if you start early. Next up is council tax. So it's not just the taxes coming out of central government that are going up, but also your council tax bill. Most councils in England are able to raise council tax rates by about 5% without needing to call a referendum, but this is split, so just take a look at this. English local authorities will be able to raise core council tax by 3%, and the adult social care, which is ring-fenced, will be able to be raised by 2%. The same limits that have applied for the past 2 years. And authorities, for the most part, have generally made full or near full use of this limit in 2024 to 25. Those rules remain basically completely unchanged for this financial year, so you could see your council tax bill increase by up to 5% again. And given that the average Band D council tax bill in England is currently £2,171, this could mean a rise of up to £109 per year. Tobacco and alcohol duty, real fun sponges this lot, aren't they? So-called sin taxes on tobacco and alcohol were also targeted in the budget. From the 30th of October last year, tobacco duty has risen by the RPI plus 2%, and duty on hand-rolling tobacco has risen by RPI plus 10%. Now, these are changes that have already hit us, but there are more changes coming in 2025. So from the 1st of February, alcohol duty will rise in line with September 2024's RPI rate of inflation, which was 2.7%. Now, alcohol duty on draft products such as beer below 8.5% will be cut by 1.7%, reducing the amount of tax on the average pint by about 1p. Generous bunch, aren't they? Never mind. Employer national insurance. So this may be one of the most discussed changes that was included in the autumn budget. The government will increase national insurance contributions for employers from 13.8% to 15% from the 6th of April 2025. And another change is that the threshold when employers need to start paying the tax will be lowered from £9,100 to £5,000. Now, at this point, I think we should be very clear that these changes aren't going to affect you directly, but it is true to say that this is an increased cost to businesses, which in all probability will pass it on to consumers, or may not have the money for pay rises, so these may end up being less generous. So it doesn't affect you directly, but it certainly and invariably will do indirectly. Electric car exemptions. So there are going to be some pretty significant changes to car tax rates as well that will take effect from April, especially for new car buyers. Starting in April, electric vehicle owners won't be exempt from vehicle excise duty, which to you and me is pretty much road tax. And that's quite the downgrade. Right now, EVs are exempt from road tax, but there is also going to be a new rate structure which will see them pay a first-year rate of £10. And if you're an EV driver, it does get even worse. EVs priced over £40,000 will face the expensive car supplement, which currently stands at £410. And let's be honest, most EVs are likely to cost over 40 grand new, so this is going to hit a pretty big chunk of the EV market. We also have road tax increases. Moving on to petrol and diesel cars, they haven't gotten away scot-free. So new cars emitting between 1 and 50 grams per kilometre of CO2, including hybrids, will see taxes rise from £10 to £110. Vehicles emitting 51 to 71 grams per kilometre of CO2 will face increases from £30 to £130. And while rates for cars emitting over 75 grams per kilometre and above will double. And at the top end, cars emitting over 255 grams per kilometre of CO2 will see first year rates double from £2,745 to £5,490. Now, these are some pretty hefty increases and is likely to put off tons of people from buying new cars, which may mean that used cars will hold their value better than they may have done otherwise. Business asset disposal relief. So this is one that gets a very fancy sounding name, but let's get into it nonetheless. This used to be called Entrepreneurs Tax Relief, but they changed the name for it back in 2020, which is also when they slashed the lifetime allowance. You used to be able to get a lifetime allowance of £10 million up until March 2020, and then they cut it right down to £1 million. Anyway, business asset disposal relief basically gives you a lower rate of capital gains tax for individuals when they get to certain disposals. This is things like the sale of shares in trading companies or holding companies of trading groups. And this was basically a really valuable relief for business owners who wanted to sell their businesses, and that's basically what it was used for mostly. For disposals made on or after the 6th of April 2025, the rate of gains eligible will increase from 10% to 14% for disposals made on or after the 6th of April. The rate will increase again to 18% for disposals made on or after the 6th of April 2026, and there's been no change to the £1 million limit. The furnished holiday lettings tax regime will be completely abolished from April 2025. The effect of abolishing the rules will basically be that this will basically mean that properties will form part of the person's UK or overseas business and be subject to the same rules as non-furnished holidays. And finally, move to non-domiciled tax status. I've kept this one last just because as I was scripting this video, there were some changes that were announced to the proposals, so it looks like they're going to get watered down anyway. But nonetheless, a non-dom is someone who is a UK resident whose permanent home or domicile for tax purposes is outside of the UK. And what this means is that a non-dom only pays tax on money that they earn in the UK, and they don't have to pay any UK tax on money that they make outside of the UK unless it's paid into a UK bank account. Now, for super wealthy people, this represented a really good opportunity and entirely legal way to pay less tax if they chose to domicile themselves in a low tax rate jurisdiction. One of the most well-known examples is a former Prime Minister's wife, and after details of her tax affairs emerged, she said that she would start paying UK tax on her earnings from outside of the UK. So what's actually changing? In March 2024, Jeremy Hunt, who was the Chancellor at the time, announced that the non-dom regime would gradually be phased out. The plan was that people who moved to the UK from April 2025 would not have to pay any tax on money they earned from overseas for the first 4 years. And then after that, if they continued to live in the UK, they would pay basically the same tax as everyone else. Anyone who already had a non-dom status would be allowed a 2-year transition period, and basically during that time they were encouraged to bring their foreign wealth into the UK tax system. Now, Labour's plans are that basically from April onwards it'll be replaced with a residence-based system, which will basically also bring foreign earnings into the UK tax system. At the time, Labour said it would extend the transition period for people to bring their money onshore from 2 years to 3. And these were the recent changes. When Rachel Reeves was in Davos for the World Economic Forum a couple of weeks ago, she said that she would, quote, tweak the transition period further to make it more attractive. So we have 2 videos that we mentioned earlier on. We have this video here, which I would really recommend you watch, about inheritance tax and a lot of the changes that have gone on there. And we also have this video here about changes to the UK tax system. Thanks very much for watching. If you've liked this video, please like and subscribe. It doesn't cost you a penny and you can always unsubscribe later. This is Modern Money Talk, where we talk all things personal finance and economics related. Thanks very much for watching.